You open the envelope from a nursing home, one page, $9,700 a month. You read it again, the number did not move. That's what your family pays out of pocket. Medicaid decides the gifts your parent already made disqualify them from nursing home coverage. So you follow the IRS rules. Your accountant said the gifts were tax-free. Your gift tax return, no tax return required. No red flag, no phone call. Medicaid does not care. Every dollar your parent gave away in the last 5 years, every birthday check, every down payment, every gift that the IRS said was perfectly fine, Medicaid counts all of it against them the day they need a nursing home. So today, I'm going to walk you through the exact penalty formula, what it costs, which transfers are exempt, and one free phone call most families never make before it's too late. So your parent gave $19,000 a year to each of the 3 grandchildren for 4 years. That's about $228,000 in transfers. They followed the rules exactly. Their accountant confirmed it. Nobody flagged anything. So your parents enters a nursing home. The family applies for Medicaid. And Medicaid looks back 5 full years and finds every dollar. The penalty formula turns those gifts into months of disqualified coverage, months where your family pays a full nursing home cost out of pocket. And the number it produces is not a line item on a statement. It's a monthly bill that arrives whether you were warned or not. First, there's something about this rule that almost no one explains clearly. And it starts with a number the IRS hands you every year that Medicaid does not recognize. I hear this every week in the group Caring for Aging Parents, and the pattern is always the same. Well, here's what Medicaid Lookback actually is. Stripped down, no jargon. When your parent applies for Medicaid to cover nursing home care, the state does not just look at what they own today. It looks backward. 5 full years from the date of application. Every financial transaction, every gift, every transfer, every dollar that moved from their name to someone else's for less than fair market value. So your parents sold their home to you for $1 3 years before they applied. The home was worth $310,000. Under Medicaid law, that is $309,999 transfer for less than fair market value. It does not matter that you live there. It does not matter that you provide their care daily. The lookback sees one number, what left their name versus what they received in return. What that means for your family specifically is this. If your parent has given away anything in the last 5 years, money, property, assets of any kind, those transfers are visible to Medicaid. Every one of them is potentially countable against their eligibility. So most families assume the lookback only catches large transfers. Well, it does not. Medicaid counts every dollar. A $5,000 check to help a grandchild with rent is treated the same way under the formula as a $500,000 property transfer. The only difference is how many months of penalty each one produces. And this is where most families walk into the biggest mistake, because there's an IRS number, $19,000 in 2026. That feels like it should protect you. Well, it doesn't. The annual gift tax exclusion for 2026 is $19,000 per recipient. So you can give up to that amount to any individual in a calendar year without filing a gift tax return. The IRS consider it tax-free, and most families treat it as permission. So your parent did exactly that. $19,000 per grandchild, 3 grandchildren, 4 years running. That's $228,000 total. Every gift was perfectly legal under the federal tax law. No return required, no flag raised, no consequence under the tax code. But Medicaid law is an entirely separate framework. And this is the part nobody connects for families until it's too late. The annual gift tax exclusion means nothing under the Medicaid lookback. not $19,000, not $1,000, not $1. Every gift your parent made, all $228,000, is the disqualifying transfer that Medicaid counts against their eligibility. They followed one legal system perfectly and walked straight into a penalty under another. So what that means for your family specifically is this. If your parent or grandparent made gifts that fell under the IRS annual exclusion, those gifts are not protected from Medicaid. They're not fully visible and fully countable in the penalty formula. So now some of you might be thinking, but my accountant said those gifts were fine. Well, your accountant was right. Under the tax law, they were fine. Under Medicaid law, they are a penalty waiting to happen. These are two completely separate legal systems. The rules of one do not carry over to the other. And the person who told you the gifts were tax-free was not wrong. They were answering a question about the wrong system. Well, you might be watching this and realizing your family made gifts in the last 5 years to fall into this window. This is the single most common planning mistake families make. They followed the IRS rules exactly and still walked into a Medicaid penalty that nobody warned them about. So what does that penalty cause? Well, the formula has two inputs and one answer, and the answer is measured in months your family pays out of pocket. And here's how the penalty formula works. Input 1, the total dollar amount of every transfer your parent made during the 5-year look-back window. For your family, that number is $228,000. Input 2, a reasonable approximation for 2026 is around $9,700 per month for a semi-private room. So the formula, total transfers divided by the state advisor equals the number of months your parent is disqualified from Medicaid coverage. 228,000 divided by 9,700 equals approximately 23.5 months. That's nearly 2 full years where Medicaid will not cover your parents' nursing home care. Your family pays the full cost out of pocket, $9,700 every single month. Well, for almost 2 years because of gifts that were legal under the tax law. What that means for your family specifically is this. Take every gift, every transfer, every dollar that left your parents' name in the last 5 years, add them up, divide by your state's divisor. That number is how many months your family pays out of pocket before Medicaid coverage begins. So now, that example uses $9,700 as a divisor because it's a reasonable national approximation. But your state's published figure is the only number that actually counts for your family, and it varies significantly. In lower cost states like Texas or Missouri, the divisor can be under $6,000 per month, which means the same transfer produces a longer penalty. A higher cost states like New York or Alaska, the divisor can exceed $15,000. Shorter penalty, same dollar amount. The real answer depends entirely on your parent's state. The $97,000 transfer in Texas at a $5,800 divisor produces nearly 17 months of penalty. The same $97,000 transfer in New York at $15,000 produces about 6.5 months. Same gift, same rule, different state. If that comparison just changed how you're thinking about this, hit the like button. It helps other families find this video before the bill arrives. Now, an elder law attorney in your parent's state will have the current divisor. So will your state's Medicaid office. If you're running these numbers in your head right now with your own family situation, well, that's exactly why I do this video. Most families never see this math until the nursing home bill is already on the table. And if your family has been through this, or if you're looking at these numbers right now and realizing your parent might be inside that look-back period, drop a comment below. Tell me where you are in this process. Because every family I hear from says the same thing. Nobody connected the dots for them. But not every transfer counts. There are specific exemptions written into the rules, and one of them might apply to your family right now. Medicaid exempts certain transfers from look-back penalty entirely. These are not loopholes. These are written into federal Medicaid law. Say you have been living in your parents' home and serving as their primary caretaker for 2 years before they entered a nursing home. Well, your parent transferred the home to you, let's say worth over $280,000. That transfer did not trigger a penalty. The caretaker child exemption protected it because you met the specific residency and documented care requirements the state verified. So what that means for your family specifically is this: if an adult child has been living in your parents' home and providing care that demonstrably delayed nursing home admission, the home transfer may be protected. If the requirements are specific and state verified, so this is not a self-declared exemption, documentation matters. Other federally recognized exemptions include the following: transfers to a spouse, transfers to disabled child, transfers to a trust established for the sole benefit of a disabled individual, and transfers where the applicant can demonstrate they intended to sell at the fair market value and receive a legitimate offer. Most families assume that once the look-back flag transfer, the penalty is locked in. Well, it is not always. If you can demonstrate that a transfer was made exclusively for the purpose other than qualifying for Medicaid, and you have documentation to prove it, the penalty can be challenged. The burden of proof is on your family, but the door is not always closed. Well, some of you might be thinking, well, my parent already made the gifts. The look-back window is already running. Is there anything we can do now? Well, in some cases, yes. If the gifts can be returned fully or partially, the look-back calculation is reduced by whatever comes back. If your parent is in a crisis situation, meaning nursing home admission is imminent or already underway, an elder law attorney can help. They can sometimes restructure remaining assets in ways that reduce the penalty legally. These are called crisis planning strategies. Well, they're time-sensitive and state-specific. The question now is where your family actually starts, and the first answer is not an attorney. Before any planning begins, one question is worth asking first. Does your parent qualify for a PACE? That's Program for All-Inclusive Care for the Elderly. PACE is a joint Medicare and Medicaid program available in many states. It provides nursing home level care while allowing the person to stay at home or in the community. If your parent qualifies and PACE is available in your area, nursing home admission may not be necessary. So no nursing home admission means no look-back trigger, no penalty formula, no calculation, none of it. So one phone call to your state's Medicaid office can tell you whether PACE is available in your parents' area. It's worth making that call before anything else. So what that means for your family specifically is this: the entire penalty discussion that we walked through today may not apply. Not if your parent qualifies for a program most families have never heard of. If PACE does not apply, well, here's where it starts. And none of these cost anything. The ACL.gov, that's the long-term care website. It's a federal government's long-term care planning portal. It covers every care setting: nursing home, assisted living, home-based care. It's free, it's federal. The Elder Care Locator, I think it's 1-800-677-1116, connects your family to local services in your parents' community. That includes counselors who walk you through your state-specific Medicaid rules at no charge. Now, Medicaid has a state-by-state beneficiary resources directory. It gives your parents' state Medicaid office directly, and every state has a SHIP program. That's State Health Insurance Assistance Program. Local counselors who help with Medicare and Medicaid questions for free. Find your state SHIP number at Medicare.gov or call the 1-800-Medicare. These are the calls your family should make before anything else. before the gifts, before the look back, before the bill arrives. It's free. It's federally regulated. The right first call before you pay anyone. Most content about Medicaid planning starts with hiring an elder law attorney. Well, that's often the right step eventually. But paying someone, let's say $400 an hour to orient you on the basics that you can learn with free phone calls is not planning. It's paying for information that already belongs to you. So after those free calls, yes, an elder law attorney license in your parent's state is a right next move. They have the current divisor. They know your state-specific exemptions. And if your family is in a crisis situation, they can move on a timeline that matters. So you came into this video thinking the IRS annual gift exclusion protected your family from Medicaid. And you're leaving it knowing something different. Medicaid has an entirely separate set of rules. And every dollar your parent gave away in this last 5 years is countable under those rules, whether the IRS required a return or not. Those are not the same situation. The gifts were not wrong. The advice was not wrong. What was missing was one sentence. Medicaid has different rules. That's a sentence nobody said to your family, but now you have it. What your family does inside that look-back window or does not do is what Medicaid sees when it counts. So here's what I want to know from you. When your family made those gifts, who explained the Medicaid side? Was it your accountant, your financial advisor, anybody? Well, tell me in the comments, because every family I hear from has different answers, and it's time that we said this out loud. The next video covers what happens when AI enters your doctor's office. The questions to ask your physician about whether AI's influenced today's recommendation. And what are the states now that legally require providers to disclose? And what you can do when AI plays a role in your care and you were never told. If you're managing healthcare decisions for an aging parent or your own Medicare enroll, click subscribe so you get notified when that video comes out. I'm Hanh Brown, and this is The Hanh Brown Show. I'll see you in the next one.